the long-awaited federal budget is out, and it includes numerous initiatives to reorient Canada's economy as it faces unprecedented trade uncertainty with the United States. That includes billions in new spending initiatives to spur investment. And joining me now to get his take is Andrew Kelvin. He is head of Canadian and Global Rate Strategy at TD Securities. It's nice to have you here.
Thank you for having me.
So I want to start, you put out a report, as you do, as soon as things come out, and it said, it brings larger deficits, more bond issuance, I'm paraphrasing here, but it doesn't break the mold. What stood out for you or didn't stand out from you in this budget?
There was a lot of anticipation around this budget, as you mentioned. I was having conversations with clients and colleagues, and people were talking about deficit numbers that they just kept escalating every week. It seemed it was going to be 70, then it was going to be 80, then 100, then 120 billion, and I think people were prepared potentially for an extremely expansive budget. I would describe this one as moderately expansive. Deficits are going to be at 1% higher as a share of GDP every year in the sort of budget horizon, which is just not nothing. It's quite significant. It's, I'd say, almost certainly enough, if done properly, if done in an efficient way that produces growth, should be enough to offset the drag from the U.S. trade dispute. But this was sold as a generational budget. I'm not sure I would describe it as such. I would say potentially the significant commitment to increased defense spending.
It's maybe this is just a good exercise in setting the context before it comes out, and they've kind of helped, kind of adjust or get people's context ready for this. Can you just go through a bit, and you talk a bit about that from a bond issuance standpoint? I mean, what was the reaction when the budget was announced, and what do you think is going to be the reaction going forward?
Well, certainly. So after the budget was released, Canadian bonds actually outperformed versus the U.S. You had a slight rally, a slight drop in yields, which tells you that market participants had been bracing for something higher than the numbers that came out. And just for context, the budget deficits that were announced were $78 billion for the current fiscal year and $65 billion for the upcoming fiscal year, which is slightly lower in aggregate than we'd anticipated. We actually thought more of the spending would come next year, just given that the fiscal year is pretty close to over. I guess they're quite comfortable. They can get a lot of the money out the door quite quickly. But I think markets had been bracing perhaps for something a little bit more expansive. Deficits are a little bit higher, and perhaps conditioned by the fact that Canada's budget deficit is still quite a bit lower than a lot of our G7 peers. I think some people were concerned this would be a sort of French-style budget, which was frankly never in the cards. Mm-hmm. So bond markets took it well. Bond issuance for this year will continue at its current pace. We had a sharp increase in issuance going back about 12 months now, a little under 12 months. That pace is sufficient to take us through the rest of the fiscal year. We'll have to see issuance slow modestly next year. Issuance should drop by about $20 billion over that fiscal year, which it's a big number, but not in the context of programs that are going from 316 to 298 billion.
Is it going to do the job, you think, because a lot of the tax people I spoke to said it's interesting because this is a budget that is trying to incent, private spending versus government spending, right? Like spend on research, spend on manufacturing builds, all those things will help you with it, but we're not going to fund you, in a dollars out right away sort of perspective. Do you think it does enough to attract investment, attract even foreign investment?
There are certainly positive steps taken in that direction. I suppose time will tell. I will say the amount of sort of funds set aside for a lot of these tax credits, the sort of new incremental funding for increasing the capital stock was fairly modest. That wasn't one of the top two line items in this budget. The top two line items were defense and the tax cut that was announced back in May. Yeah. I think it's a sensible approach for a couple reasons. First, I always get a little bit wary when the government's out trying to pick winners and losers at scale. Right. I don't think governments necessarily have the best incentive structure to do that. And second, just sort of the speed of getting money out the door. If the private sector is acting in response to changing incentives, it's a lot easier to mobilize capital quickly in a way that supports growth in the near term, as opposed to a government project which might take a long time to formulate and actually get the money into the economy. And frankly, our needs to boost growth, they are now, not necessarily the future. Yeah. We are in this trade dispute with the U.S. now, and we are adjusting now. So the quicker the money can hit the street, the better. So I think it's a very sensible approach. But really, the proof will be in the pudding, if you'll excuse the very cliched comment there. We will need to see if businesses actually do react to it.
Yeah, and this is all, I guess, in context of the one big beautiful bill and how do we measure up and what's the arbitrage there, I guess I would say, for people. What about, you and I were chatting just before this started too, and you said, investments needed now. This is the time we need it. But when you were looking out into the future, some of the projected deficits were interesting. What caught your eye there?
Yeah, that was interesting because normally when you see a budget deficit or a budget document come out, you have a reasonable degree of certainty around what this year's number will be and next year's number will be, but there's always a 5-year projection, and it always has this sort of like fairly aggressive normalization path where you'll get to pretty comfortable budget deficits 5 years out. It used to be people would always make it so then the 5th year, that was when you had the balanced budget.
Yeah.
Then there's a bit of drift there where we were looking for just smaller deficits in the future, but still deficits. I was expecting that we would have a sort of anchoring forecast of a deficit of a little under 1% of GDP. That's something that the government had talked about on the campaign trail. They had talked about running persistent deficits. They told us that we weren't going back to zero, to be fair to them. But they're looking at deficits in 2030 of 1.5% of GDP. That is certainly higher than I would have expected. And the one thing we always know is whatever that number is, it's not going to be the one they projected 5 years ahead of time.
Yeah.
But I think what it tells you, this government intends to keep running like a reasonably expansive fiscal policy. Their funding requirements, their net funding requirements over the next 3 years run at about $150 billion per year, which is high.
Yeah.
So I think this is the government.
So debt is the reality.
I think debt is the reality here.
Yeah. Bank of Canada. Yep. They've seen the budget that's come out. How do they react to this? Because I think so far this year, and correct me if I'm wrong, we're at 2.25. We've had about 4 cuts this year. Now what?
I think the Bank of Canada probably isn't terribly surprised by anything we've seen in the budget. They've been talking about fiscal stimulus providing support for the Canadian economy going all the way back to the September meeting. We saw that in their summary of deliberations. I think the deficits that we've seen, because I think about just from a top-down perspective, what is the sort of incremental new spend into the economy? That should be enough to provide an offset to the drag we've seen so far from the U.S. trade dispute, enough to get growth above trend next year. And keep in mind, in a about zero population growth environment, the trend rate of growth is somewhere around 1% in real terms. It's not 2% is no longer the bar we need to hit. We need to hit a 1% bar. Should be enough stimulus here to achieve that. As such, I expect the Bank of Canada to remain on hold at 2.25 percentage points for really the entirety of 2026.
Okay. And what about the loonie reaction or the FX markets? What were you seeing when it came out? And then maybe just kind of dovetail that to me into what you're expecting for the upcoming year.
Yeah, certainly. FX markets largely ignored the budget, to be perfectly honest.
Interesting.
There was more focus around it, I think, in the fixed income space than the currency space. Yeah. And if we had seen a really maximalist budget, I'm sure there would have been an FX reaction. But as things stand, the FX market didn't really react terribly strongly to it. The Canadian dollar had been sort of weakening through the day, and it just sort of continued weakening, and I wouldn't want to put that on the budget. Sometimes there's just other things happening. So I don't think this changes the outlook for the loonie. And my sort of big picture on the loonie, I tend to think that central bank differentials are the most important drivers for currencies. That is definitely an oversimplification, but it's worked mostly for me in my career, so I'm going to stick to it. We think the Bank of Canada is done cutting rates here. We think the Federal Reserve will get to 3% in the second half of next year. That's something that should put downward pressure on the US dollar, which turns into a moderate appreciation in the Canadian dollar.
How does that, and again, many factors at play, but primarily to your point, central bank differentials, if that happens, how does that influence the need for investment? I'm thinking even foreign investment into Canada. Like, is this material from your perspective, not so material?
I don't think the currency is going to be the decisive factor there. The Canadian dollar has been a very stable currency in sort of the grand global scheme of things for a number of years now. I don't think the Canadian dollar appreciating by a few cents or depreciating by a few cents is going to change investment decisions one way or the other. The much more important things are the sorts of tax incentives, the lower regulatory burden, and continued access to the U.S. market for most of our industries. Like, those will be the things that cause people to make decisions, not a few cents one way or the other on the Canadian dollar.
I was asking you earlier as well, what questions you're getting asked from people, and they're like, will this pass? That's like, and it is an important one. I mean, the budget's not the budget yet. Like, it is, it's proposed.
Yep.
How do you think about this? Because I know you don't, politics matters to you, but it's not everything you focus on.
So The way I think about this is it doesn't seem like it's really in any party's interest to have an election here. If you look at some of the polling aggregators, they suggest that polls are consistent with the current composition of Parliament. Given that we already had an election this year, I don't know that there's much appetite for election from all the parties to come back to have a pretty close to the same configuration. I'm quite certain there's not a lot of appetite for another election on behalf of Canadians, particularly given that this is, I think most people would agree with the government's assertion that there is a little bit more urgency about getting our own house in order, given the sort of changes in that Canada-US relationship. Now, it's always possible that all four parties will overplay their hands here and force each other into triggering an election.
Possible, but not probable.
Thereby making me look like, a fool. But I would put a quite low probability on that, given that we only need a few abstentions for this budget to pass. And I wouldn't be surprised to see a few people come down with a sudden case of the chills on voting day.
Fair enough. Can I ask you, just now that the dust has settled, you've had time to digest this, write about it, what are you focused on when you kind of think ahead for Canada in terms of what needs to happen?
I think we need to see some of these tax measures designed to attract capital investment from businesses to actually materialize into better business investment. One thing they do talk about in this budget document is Canada's capital stock is too low. We will actually need to see these measures have their desired consequences. And I'll be looking to see what the next sort of round of projects we see from the Major Projects Office are. They were discussing a port in Churchill, they were discussing high-speed rail in central Canada, a wind farm in Atlantic Canada, carbon capture in Alberta, which could be a really key one because that is something that this government has connected to lifting of oil and gas emissions caps. And if we're serious about making Canada an energy superpower, that's probably not consistent with limiting our ability to produce energy.